I'm MaryAnn. We've seen a lot of M&A activity in certain sectors recently, but my next guest says that for this stage of the credit market cycle, there should really be a lot more. Greg Kocik is portfolio manager of the TD High Yield Bond Fund. So what's been going on? We're 5 years since that last recession. What's happening?
Well, there's several factors at play. I mean, one of the obvious ones is the 08-09 experience was so bad for a lot of people who were involved in M&As that they still haven't forgotten how terrible that experience was. In fact, in a high-yield market, there's probably still 3 or 4 large M&As from 07 that are still being restructured today.
Really?
So
wow.
that is this big cloud that is still there, that is reminding people all the time how dangerous leveraging up can be. So that's one factor. The other one is just if you look at bank activity, because you need bank loans in order to finance some of those large takeovers. There has been a lot of bank lending, but it's really going to consumer-related or small business, maybe even small business-related activities, auto lending and things like that, student lending, but not lending for mega M&As. And I think it's a function of the regulator. The regulator is a lot more careful and public about warning banks on not taking on too many of these risky leverage deals.
Right, because we saw the Tim Hortons Burger King deal. That was big news this week. But you're saying that's not quite as big as you might expect?
There's always an exception to what I just said, and one of the reasons why this is being done is the shareholder 3G, as were in Warren Buffett. They not only do have deep pockets, or obviously Mr. Buffett has really
very deep pockets, yes.
deep pockets, but they have 3G has a significant operating experience and a real operating experience and a way to manage costs better than previously it was possible in the previous setup. So there is an occasional transaction like that that does make sense. Especially if you have somebody like Warren Buffett financing part of it with sort of a semi-equity type of instrument.
Right. Yeah, okay, that makes it a little less painful, I guess, for people having to go to the bank. So you're finding M&As restricted just to certain sectors then?
I think that you will find them more in companies such as Tim Hortons, actually, consumer product companies with significant barriers to entry, very large market presence, and free cash flows. Which you can forecast. If you're doing forecast for Tim Hortons, you can probably be comfortable with 5, 6, 7 years of free cash flows, not being impacted by a recession. So those types of businesses that are not very cyclical, they will always attract some sort of a bid, some sort of an M&A possibility. You're not seeing a lot of that in more cyclical businesses. The resources obviously are not really very active. Even in industrials, which are a place to be supposedly these days, they're not really seeing a huge wave of M&As that you normally would see. Again, because of the risk aversion, I think. The board of directors of some of these cyclical companies is probably afraid of taking on too much leverage. But things like consumer products, if it's related to food or something of that nature, that definitely always is quite popular.
So is that then because of where we are in the credit cycle?
Yeah, I mean, we quite often hear, well, we are 5 years from the recession and therefore we should see a lot more of M&As, or we should see some sort of a change in credit cycle that people are taking on more leverage. Or if you look at equity market, people are saying, well, maybe this is time for the equity market to pause because we hit 5 years.
Right.
Except that 5 years, that's from the depression almost. We didn't have a recession. We had a complete collapse of liquidity in 08-09. So really, in my mind, you really have only 2 years of a normal cycle from 2012. Between 08 to 2011, 2012, you really had a rebuilding of balance sheets, consumer balance sheets and corporate balance sheets in the U.S. It's really the last 24 months that we have more normal economy. And that's why you actually are not seeing some of these excesses that you typically would see. We still have probably several years of normal economy where some of this activity may still play out.
So it's still too early right now.
I think it's still too early for someone.
What about in Europe, where we're seeing, bonds going down, or yields going down anyway, bonds going up? What's going on there?
Yeah, it really is quite incredible
Yeah.
to see, because here we are worried about being sort of a little maybe late in the cycle in the US, and 5 years versus 2 years, whatever, how you define it. We worried about the yields going up because the economy is doing so well. In Europe, it's the other way around. And obviously the European economy has slowed down over the last couple of years. Number one. Number two, the reforms they were supposed to take really have not panned out as much as you would hope. Spain has done some reforms. Italy is trying to do something. France is not doing anything with reforms. So you really have rigid markets in terms of labor, for example. The social programs have not been reformed. There's no incentive for companies to hire, because it's very difficult to lay off people in some sort of a slowdown. So those economies are simply too rigid, unreformed, and just growing really slowly. The other last point on Europe is the demographics of Europe is a lot more challenging than it is in North America or in emerging markets. You actually have the pool of working age population is actually starting to decline now, which is probably the key reason for the low inflation and slow growth, and therefore you're going to end up with low interest rates.
So it might take them a little longer, even than us, to get out of that cycle.
I think so. I think it's a multi-year process for them.
Interesting. So where do you see the outlook then for high yield?
Well, high yield bonds, I continue to believe that despite their very low yields, they're still in a sweet spot. Having said that, you have to be very, very selective, just like in investment, like in any asset class. But it's not like we are in 2009 or 10 where you could buy the whole market and
everything goes up.
And everything goes up. You have to be a lot more selective today. But as I said, we are in the early stages of this credit cycle, because we just came out 2 years ago from this kind of depression type mentality. I would argue. So you have spreads of about 400 basis points today in the high yield space. The overall yield is only 5.3%. But the good news is that the loss rate caused by defaults is extremely low. It's something on the order of less than 1%. So you're picking up a spread of 4%. Let's say if you're buying the whole market, you're picking up 4%, you're losing maybe 1% or less than 1% if you're buying the whole market. So you're still ahead quite a lot. Historically, that spread between spread and default was not 3%. It's more like 1.5% to 2%. So there's still maybe 100 basis points of cushion in the high yield market, which compensates you for any unforeseen credit risks.
So definitely, as long as you do your homework, it looks like a very interesting place to be.
Yeah, you have to be definitely doing a lot of homework to avoid the pitfalls that may crop up.
All right. Thank you very much, Greg.
Great. Thank you.
I've been joined by Greg Kocik, who's portfolio manager of the TD High Yield Bond Fund. Thanks for watching.